There is a very special kind of investor in this world, one who does not chase hot stocks, does not panic when markets fall, and does not listen to the noise of daily financial news. And that investor is someone who thinks clearly, acts patiently, and builds real wealth over a long period of time by following a set of proven principles that have worked for decades. And today, you are going to hear about those exact principles, drawn from one of the most important works ever written about investing wisely. And the man who put these ideas together, Charlie Tian, spent years studying the greatest investors of our time, people like Warren Buffett, Charlie Munger, Peter Lynch, Joel Greenblatt, and many others, and he distilled their thinking into a clear, practical, and powerful approach that any serious investor can learn and apply. And whether you are brand new to investing or you have been at it for years and feel like something is still missing, what you are about to hear could change everything about how you look at money, markets, and the future. So stay with this, because the ideas here are not just interesting, they are genuinely life-changing if you let them be. The world of investing is full of people who think they know what they are doing, but consistently lose money. And it is also full of people who seem to win by luck for a little while and then give it all back. And then there are the rare few, the ones who grow their wealth steadily, year after year, decade after decade. And it turns out those rare few are not doing something mysterious or magical. They are following principles that are available to anyone willing to learn them. And Charlie Tian's great contribution is that he made those principles easier to understand and easier to use in the modern world. And he did this by founding a platform called Guru Focus, which tracks what the greatest investors in the world are actually buying and selling, not what they say in interviews, not what analysts predict, but what they actually do with real money. And this distinction matters enormously because actions always tell a truer story than words. And over years of studying those actions, Charlie Tian began to see clear patterns, clear principles, clear methods that separated the great investors from everyone else. And that is what you are about to hear. Let us begin with the most foundational idea of all. Most people approach the stock market the wrong way. They see a stock going up and they want to buy it because it feels like it is winning. And they see a stock going down and they want to sell it because it feels like it is losing. And this is the exact opposite of how great investors think. And understanding this one distinction is worth more than almost any piece of financial information you will ever encounter, because the great investors do not buy what is going up. They buy what is cheap relative to its true value, and they sell what is expensive relative to its true value. And this simple reversal in thinking is the foundation of everything that Charlie Tian teaches in his work, and it has a name. It is called value investing, and it has been around for nearly a century, first formalized by Benjamin Graham, then perfected by Warren Buffett, and now studied and practiced by some of the most successful money managers on the planet. Value investing starts with a simple but powerful observation. Every business has a true worth, what we call its intrinsic value, and at any given time, the price of a stock in the market may be higher than that intrinsic value, or lower than it, or roughly equal to it. And the job of the value investor is to figure out what the intrinsic value is, and then buy the stock only when the market price is meaningfully below that value. Because when you do that, you are essentially buying a dollar's worth of business for 70 cents, or 60 cents, or sometimes even 50 cents. And over time, the market tends to recognize the true worth of a good business and push the price back up. And when that happens, you profit, not because you were lucky, not because you guessed right, but because you were disciplined and patient, and you did the work to understand what you were buying before you bought it. This idea of buying below intrinsic value is sometimes called buying with a margin of safety, and the phrase comes from Benjamin Graham, who was one of the wisest financial thinkers who ever lived. And the margin of safety is exactly what it sounds like. It is the gap between what you pay and what the business is actually worth. And the bigger that gap, the safer your investment. Because even if you are wrong about something, even if the business performs a little worse than you expected, you still have room to come out ahead, or at least to not lose very much. And conversely, when you buy stocks that are already priced at or above their true value, There is no margin of safety. There is no cushion, and even a small disappointment can lead to a large loss. Charlie Tian goes to great lengths to explain why this matters so much, and he uses the analogy of buying a house. Imagine you are buying a house that a real estate expert tells you is worth $100,000. And if you can buy it for $60,000, that is a wonderful deal. And if you have to pay $120,000 for it, that is a risky deal. And if you pay $200,000 for it, that is almost certainly going to end badly for you. And the stock market works exactly the same way, except that in the stock market, prices change every single day, and people get caught up in those daily movements and forget to ask the most important question, which is, what is this business actually worth? The answer to that question requires understanding what makes a business valuable in the first place. And this is where Charlie Tian introduces a concept that runs through everything else in his teaching. And that concept is the quality of the business itself, because not all businesses are created equal. And the very first lesson that most new investors learn the hard way is that buying a cheap stock in a bad business is almost always a mistake. And the greatest investors of our time figured this out and moved away from just buying anything cheap and toward buying wonderful businesses at fair prices. Warren Buffett himself has said that it is far better to buy a wonderful company at a fair price than to buy a fair company at a wonderful price. And this shift in thinking, from pure cheapness to quality combined with reasonable price, is one of the most important evolutions in the history of value investing. And Charlie Tian's work is largely built around helping investors understand what makes a business wonderful and how to identify those businesses before the market fully recognizes them. So what makes a business wonderful? The answer begins with something called a competitive moat. The word moat refers to the water that used to surround castles to protect them from enemies. And in the world of business, a moat means the competitive advantage that protects a company from rivals. And just as a wide and deep moat made a castle hard to attack, a wide and deep economic moat makes a business hard to compete against. And the businesses with the strongest moats are the ones that keep earning high profits year after year, even as competitors try to take their customers away. And these are the businesses that great investors love to own because their earnings are more predictable, more durable, and more likely to grow over time. Charlie Tian identifies several different kinds of economic moats, and understanding them is crucial for any investor who wants to pick great businesses. And the first kind of moat is the brand moat, which exists when a company has built such a powerful brand that customers prefer its products over competitors, even when the competitors are cheaper or technically similar. And the classic examples here are companies like Coca-Cola, which has been around for over a century and continues to sell billions of servings every year around the world, simply because people trust and love the brand. And there is something almost magical about a great brand, because it allows the company to charge a little more for its products, and that extra profit, collected over millions or billions of transactions, adds up to enormous value over time. The second kind of moat is the switching cost moat, which exists when customers find it very difficult or very expensive to switch from one company's product to another. And this might not sound as glamorous as a brand moat, but it is actually extremely powerful because it creates what is essentially a captive customer base. And the best examples of switching cost moats come from the technology sector, where companies that provide essential software or infrastructure find that their customers are deeply embedded in their systems and would face enormous disruption and cost if they tried to move to a competitor. And once you have thousands of employees trained on a particular software system, all your data stored in a particular format, and all your processes built around a particular platform, the cost and pain of switching is so high that you simply do not do it, even if a competitor offers something a little better or a little cheaper. The third kind of moat is the network effect moat, and this is one of the most powerful forces in modern business. And the idea is that a product or service becomes more valuable to each user as more users join. And the classic example is a telephone network, which is worthless if only one person has a telephone, but becomes enormously valuable as more and more people join, because now you can call anyone. And in the modern world, the same principle applies to social networks, payment networks, marketplace platforms, and many other kinds of businesses. And the reason this creates such a powerful moat is that once a network reaches a certain size, it becomes almost impossible for a newcomer to compete because they start with zero users, and no one wants to join a network that no one else is on. The fourth kind of moat is the cost advantage moat, which exists when a company can produce its goods or services at a lower cost than any competitor, either because of the way it is structured, the scale at which it operates, or the unique resources it controls. And companies with genuine cost advantages can price their products lower than competitors and still make good profits, or they can price at the same level as competitors and pocket more profit. And either way, they are in a very strong competitive position that is hard to attack. The fifth kind of moat is the efficient scale moat, which exists in markets that are naturally limited in size and where one or two players can serve the entire market profitably, but where adding a third or fourth player would make the whole market unprofitable for everyone. And this tends to happen in things like local utilities, pipelines, and certain kinds of transportation infrastructure where the capital costs are so high that it does not make sense to build competing infrastructure. And the result is that the existing players have a protected position that is very hard to challenge. Charlie Tian emphasizes that the presence of a moat is not enough by itself. You also need to assess whether the moat is wide or narrow, and whether it is growing or shrinking. And a wide moat that is growing is the best of all possible situations, while a narrow moat that is shrinking is a warning sign that the business may be in trouble, even if it looks profitable today. And one of the key skills of the great investors is being able to look beyond today's profits and see whether the business will still be dominant 5 or 10 or 20 years from now. This brings us to one of the most important concepts in Charlie Tian's approach, which is the idea of predictability. Great investors love predictable businesses. A predictable business is one where you can look at the history of its earnings and revenues and see a smooth, consistent pattern of growth, where the business earns roughly what you would expect year after year, where there are no wild swings up and down, no years where everything falls apart, followed by years where everything recovers, just steady, reliable, growing earnings. And the reason predictability matters so much is that it makes valuation much easier, because when you are trying to figure out what a business is worth, you need to make estimates about the future, and the more predictable the business, the more confidence you can have in those estimates, and the more confidence you have in your estimates, the better your investment decisions will be. Charlie Tian points out that many of the greatest investments of all time have been in businesses that were almost boringly predictable, companies that sold everyday products or services that people needed year after year, businesses whose revenues and profits were as reliable as the sunrise. And while these businesses might not generate the excitement of a fast-growing technology startup, they have created enormous wealth for patient investors who bought them at reasonable prices and held them for decades. The opposite of a predictable business is one whose earnings are highly volatile, perhaps because it operates in a cyclical industry like mining or construction or automobiles, where demand swings dramatically with the economic cycle, or perhaps because it is in a rapidly changing technology space where today's dominant product can be obsoleted tomorrow. And while there can sometimes be money to be made in unpredictable businesses, it is much harder to do because your estimates about the future are inherently less reliable, and the margin of safety you need is much larger to compensate for that uncertainty. Now let us talk about how to actually measure quality in a business, because having the right concepts is only half the battle, and you also need to know how to look at the numbers. One of the most important measures of business quality is return on equity. Return on equity tells you how much profit a company generates for every dollar that shareholders have invested in the business. And a company that consistently earns a high return on equity is demonstrating that it has the ability to take capital and turn it into profits very efficiently. And this is a sign of genuine competitive advantage, because if any competitor could do the same thing, they would, and competition would drive the returns down. And the fact that certain companies sustain high returns on equity for many years is evidence that they have something special protecting them from competition. Charlie Tian suggests looking at return on equity over a long period, ideally 10 years or more, and looking for companies that consistently earn returns of 15% or more, meaning that for every $100 of shareholders' equity, the company earns $15 or more in profit each year. And while 15% may sound modest, think about what it means over long periods, because a business earning 15% on equity and reinvesting those earnings can double in value roughly every 5 years, and over a decade, that is 4 times the original value, and over 2 decades, that is 16 times the original value. And that kind of compounding is the foundation of great long-term investment returns. But return on equity has to be interpreted carefully, because a company can boost its return on equity by borrowing a lot of money. And while financial leverage can amplify returns in good times, it also amplifies losses in bad times and increases the risk of financial distress. So Charlie Tian always looks at return on equity alongside the debt level of the company, and he prefers companies that achieve high returns on equity with modest or conservative levels of debt, because those companies are genuinely efficient and not just levered up. A related measure that Charlie Tian emphasizes is return on invested capital, which is similar to return on equity, but looks at the returns generated on all the capital in the business, including both equity and debt. And this gives an even clearer picture of how efficiently the company uses all the resources available to it. And again, consistently high returns on invested capital over many years are a strong signal of a durable competitive advantage. Another key measure is the profit margin, which tells you how much of each dollar of revenue the company keeps as profit after paying all its costs, and high profit margins are another sign of competitive strength because they suggest the company has pricing power, meaning it can charge enough for its products or services to cover its costs comfortably and still have a lot left over. And companies with pricing power are generally those with strong brands, unique products, or some other form of competitive advantage that allows them to resist pressure to lower their prices. Free cash flow is another crucial concept in Charlie Tian's framework. Free cash flow is the cash that a company generates from its operations after paying for the investments needed to maintain and grow its business. And this is in some ways even more important than reported earnings, because cash is real and cannot be faked, the way accounting earnings sometimes can. And a business that consistently generates strong free cash flow has genuine economic power that it can use to pay dividends, buy back shares, acquire other companies, or simply build up cash reserves for future opportunities. Charlie Tian emphasizes that great businesses are ones that can grow without needing to continuously pour large amounts of new capital back into themselves. And this is the difference between what he calls a capital-light business and a capital-heavy business. And the capital-light business earns good profits and does not need to spend all those profits on new equipment, new facilities, or other capital expenditures just to maintain its position, so the cash flows freely to shareholders. And the capital-heavy business also earns decent profits, but has to reinvest most of them just to stay competitive, leaving little for shareholders. And when you compare these two types of businesses over the long run, the capital-light business is almost always the better investment. Now, let us turn to the question of valuation, because even the most wonderful business in the world can be a bad investment if you pay too much for it. Charlie Tian devotes significant attention to the various methods of valuing a business, and the most commonly used tool in his framework is the price-to-earnings ratio, which is simply the price of a share divided by the earnings per share. And this ratio tells you how much you are paying for each dollar of the company's annual earnings. And a lower ratio means you are paying less for each dollar of earnings, which is generally better, while a higher ratio means you are paying more, which is generally riskier. But the price-to-earnings ratio has to be used thoughtfully, not mechanically, Because different businesses deserve different valuations for legitimate reasons. And the main reason one business might deserve a higher ratio than another is its growth rate. Because a business that is growing its earnings quickly is worth more than a business with the same current earnings but no growth. And a business with strong competitive advantages and high predictability is worth more than an equally profitable business in a more uncertain or competitive industry. Charlie Tian introduces what he calls the price to earnings to growth ratio as a way to account for the growth rate when evaluating whether a stock is cheap or expensive. And this ratio is calculated by dividing the price to earnings ratio by the earnings growth rate. And when this ratio is significantly below 1, the stock may be attractively priced relative to its growth, while when it is significantly above 1, the stock may be expensive relative to its growth. But again, this is a guideline, not an absolute rule, and it should be combined with a qualitative assessment of the quality of the business. Another valuation tool that Charlie Tian discusses is the discounted cash flow analysis, which is a more sophisticated method of valuing a business by projecting its future cash flows over many years and then discounting those future cash flows back to the present day using an appropriate discount rate. And the idea behind discounting is that a dollar received in the future is worth less than a dollar received today because you could invest today's dollar and earn returns on it over the intervening years. And by adding up all those discounted future cash flows, you get an estimate of the business's intrinsic value today. The discounted cash flow analysis is powerful, but also tricky because it requires you to make estimates about the future that can be quite uncertain, especially for businesses growing rapidly or operating in fast-changing industries. And small changes in your assumptions about growth rates or discount rates can lead to large changes in your estimated intrinsic value. And this is why Charlie Tian always emphasizes the importance of using a margin of safety. Because even if your intrinsic value estimate is off by 20 or 30%, you still do well if you bought at a significant discount to your estimate. Charlie Tian also discusses the book value of a company, which represents the accounting value of the assets minus the liabilities, and the price-to-book ratio compares the market price to this book value. And in the old days of value investing, buying stocks at low multiples of book value was a central strategy, and it worked well for a long time. But the world has changed, and today many of the most valuable businesses in the world have very little physical assets. Their value comes from intellectual property, brands, customer relationships, and other intangible assets that do not appear on the balance sheet at their true worth. And so for modern investors, the price-to-book ratio is less useful than it used to be and has to be supplemented with other measures. Now let us talk about one of the most important and fascinating aspects of Charlie Tian's approach, which is the study of what the great investors themselves are doing. Guru Focus, the platform that Charlie Tian founded, tracks the portfolios of hundreds of the world's greatest investors with a delay, because investment managers with more than a certain amount of assets are required by law to disclose their holdings regularly, and this creates an extraordinary window into the thinking and decision-making of some of the sharpest financial minds on the planet. And Charlie Tian has spent years analyzing these disclosures to understand what patterns emerge, what kinds of businesses the gurus tend to buy, at what valuations they tend to buy, and how long they tend to hold. One of the most consistent patterns that emerges from studying the great investors is that they tend to concentrate their holdings in a relatively small number of businesses, typically somewhere between 10 and 30 different investments, rather than the hundreds of stocks that make up a typical index fund, or the dozens that an average mutual fund might hold. And this concentration is not recklessness, but rather reflects the conviction that comes from deep research. Because when you have truly understood a business, truly believe in its competitive advantages, and are genuinely confident that you are buying it at a discount to its intrinsic value, you should be willing to put a meaningful amount of money into it, and spreading yourself too thin dilutes the impact of your best ideas. Warren Buffett has often said that if you have more than 20 ideas in your investing career that are truly great, you are remarkably lucky. And this gives you a sense of how selective the greatest investors are about what they own and how patient they are in waiting for the right opportunity, because they would rather hold cash for months or years, waiting for the perfect pitch, than swing at mediocre opportunities just to keep their capital working. Charlie Tian also observes that great investors tend to buy on weakness rather than strength, meaning that they tend to add to their positions when prices have fallen and others are panicking, rather than when prices are rising and excitement is building. And this takes enormous psychological fortitude because it means consistently doing the opposite of what feels natural and comfortable, and it means being willing to look wrong and feel embarrassed in the short term in order to be right over the long term. The ability to separate short-term price movements from long-term value is one of the defining characteristics of great investors, and Charlie Tian emphasizes this throughout his work, because in the short term, stock prices are driven by all kinds of things that have nothing to do with the underlying value of the business. Sentiment, news, market mood, economic fears, political events, and countless other factors can push stock prices far away from intrinsic value for months or even years. But over the long term, the price always tends to converge with the underlying value, and patient investors who understand this can take advantage of short-term mispricings to buy wonderful businesses at discounted prices. Let us now go deeper into what Charlie Tian calls the business perspective of investing. Most people who invest in stocks think of themselves as buying little pieces of paper that they hope will go up in price. But great investors think of themselves as buying partial ownership in real businesses, businesses that have employees, customers, products, competitors, and all the other attributes of a real enterprise. And this shift in perspective changes everything about how you approach investment decisions. When you think like a business owner, you ask different questions than when you think like a trader, and instead of asking whether the stock will go up in the next few months, you ask whether the business will earn more money 5 years from now than it does today. And instead of asking what the market thinks of the company, you ask what the company's actual competitive position looks like. And instead of following the mood of other investors, you study the economics of the industry and the specific strengths and weaknesses of the company you are considering. Charlie Tian teaches that when you evaluate a business for investment, you should ask yourself whether you would be happy to own the entire business at the current market price, not just a few shares, but the whole thing. And if the answer is yes, that is a strong signal that the investment is attractive. And if the thought of owning the entire business fills you with worry or uncertainty, that is a signal to stay away, regardless of how cheap the stock might look by conventional measures. This business owner mindset also helps you think clearly about what management does with the profits of the business. And this is an area that Charlie Tian discusses at considerable length because capital allocation, meaning the decisions about how to deploy the earnings and cash flows of the business, is one of the most important determinants of long-term shareholder value. A management team that allocates capital well can take a mediocre business and make it great over time, while a management team that allocates capital poorly can take a great business and slowly destroy it. And the history of corporate America is full of both examples. And knowing how to assess management's capital allocation skills is a critical part of evaluating any investment. The best capital allocation typically takes one of several forms. First, reinvestment in the core business at high rates of return, which is the ideal scenario for a company with strong growth opportunities and durable competitive advantages. Because when a company can take $1 of earnings and reinvest it to generate a high return on that dollar, the value of the business compounds rapidly, and shareholders benefit enormously without ever receiving any cash directly. Second, paying dividends to shareholders, which is a good approach when the business has limited high-return reinvestment opportunities and is mature enough that its earnings are highly reliable, and dividends have the wonderful property of compounding over time when they are reinvested, and companies with long histories of growing their dividends consistently are some of the most valued investments among serious long-term investors. Third, buying back shares, which is a particularly attractive use of capital when the stock is trading below its intrinsic value, because buying back undervalued shares effectively increases the ownership stake of remaining shareholders in the business at a price that is favorable. And over time, this can be enormously value creating. And many of the great capital allocators of our time have used share buybacks as a key tool for enhancing shareholder value. Fourth, making acquisitions, which is the most complex and dangerous form of capital allocation because so many acquisitions destroy value by overpaying for other businesses, and the history of mergers and acquisitions is littered with disasters where executives paid far too much for other companies because they were excited about strategic synergies that never materialized. And the great investors are very skeptical of companies that are serial acquirers unless there is a long and proven track record of buying businesses at sensible prices and integrating them successfully. Charlie Tian is particularly interested in management teams that think and act like owner-operators, meaning managers who have significant personal stakes in the business and therefore think about every decision in terms of its long-term impact on the per-share value of the business, rather than in terms of short-term metrics like quarterly earnings. And these owner-operator managers tend to be more patient, more disciplined, more focused on the right things, and ultimately more successful in creating long-term wealth for all shareholders. Now let us discuss the concept of what Charlie Tian calls the 10-year test. When evaluating any business for long-term investment, Charlie Tian suggests asking yourself whether you can predict with reasonable confidence what the business will look like in 10 years, and specifically, whether its competitive position will be similar or better than today, whether it will be earning significantly more money than today, and whether it will still be relevant and important to its customers. For some businesses, answering these questions is relatively easy because the nature of what they sell changes very slowly. Their competitive advantages are structural and durable, and there is no obvious reason to expect that the industry will be fundamentally disrupted. And these are the kinds of businesses that great investors love to own for very long periods. For other businesses, the 10-year question is very difficult to answer because the industry is changing rapidly, because technology is disrupting traditional ways of doing things, because competitors are emerging from unexpected places, or because the regulatory environment is uncertain. And in these cases, the honest answer might be that you simply cannot predict the future with enough confidence to justify a large investment at any price, let alone at a premium price. Charlie Tian is very explicit that it is better to pass on an attractive-looking investment in an unpredictable business than to stretch your analysis to justify a purchase that you are not really confident about. And this is one of the areas where great investors differ most from average investors, because the great ones have the discipline to say no to many things and to wait for the rare situations where they have genuine conviction backed by genuine understanding. The 10-year test also applies to the moat, and you should ask not just whether the company has a strong moat today, but whether that moat will be wider or narrower in 10 years. And there are industries where moats tend to widen over time as companies get bigger and more entrenched, and there are industries where moats tend to erode over time as technology changes, regulation changes, or consumer preferences shift. And being on the right side of this dynamic makes an enormous difference to long-term investment returns. Let us now talk about some of the specific warning signs that Charlie Tian flags as reasons to be cautious about a potential investment. The first warning sign is high debt. Companies that carry a lot of debt relative to their earnings or cash flows are in a vulnerable position because when business conditions deteriorate, as they inevitably do from time to time, high debt companies can find themselves in serious financial trouble, unable to meet their interest payments, forced to sell assets at bad prices, or in extreme cases, facing bankruptcy. And investors in these companies can suffer devastating losses even if the underlying business eventually recovers. And Charlie Tian consistently emphasizes that financial strength is one of the key attributes of a great long-term investment. And that is why he prefers companies with little or no debt, or at most, debt that is well within the company's capacity to service comfortably under a range of scenarios. The second warning sign is declining margins. When a company's profit margins are shrinking over time, that is often a sign that the competitive moat is eroding, perhaps because new competitors are entering the market and forcing prices down, or because customers have more alternatives and more bargaining power than they used to have, or because the company's cost structure is becoming less efficient relative to competitors, and whatever the reason. Declining margins are a red flag that deserves careful investigation before any investment is made. The third warning sign is management that seems more focused on short-term metrics than long-term value creation. Management teams that are obsessed with meeting quarterly earnings estimates, that make decisions designed to boost the stock price in the short term at the expense of the long-term health of the business, or that engage in accounting manipulations to make earnings look better than they really are not the kind of people you want in charge of your capital. And Charlie Tian devotes considerable attention to helping investors recognize the signs of low-quality management and distinguish them from the high-quality owner-operator types that are associated with the best long-term investments. The fourth warning sign is operating in an industry with no barriers to entry. Some industries are so easy to enter that whenever profits start to look attractive, new competitors pour in and quickly erode those profits back to minimal levels. And in these industries, even the best companies have difficulty maintaining durable competitive advantages because there is always someone willing to do the same thing for a little less money. And investors in these businesses need to be very cautious about paying high prices for what looks like current profitability, because that profitability may not last. The fifth warning sign is rapidly changing technology in a company's core market. Technology change can be enormously value-creating for the companies doing the disrupting, but it is usually value-destroying for the companies being disrupted. And one of the great risks in investing is buying into a business that looks strong and well-managed today, but is actually about to be made obsolete by a new technology or a new way of doing things. And Charlie Tian urges investors to think carefully about the long-term trajectory of technology in any industry they are considering investing in. The sixth warning sign is aggressive accounting. Great companies do not need to push the boundaries of accounting rules to make their results look good, because their genuine economic performance is strong enough to speak for itself. And when a company's management seems to be making aggressive accounting choices that give their earnings a favorable appearance in the short term at the cost of accuracy or sustainability, that is often a sign that the underlying business is not as strong as it appears, and sometimes it is a sign of something more serious. And Charlie Tian teaches investors to look carefully at the footnotes of financial statements and to be skeptical when accounting choices seem consistently designed to flatter the reported results. Now, let us discuss what Charlie Tian teaches about when to sell. Knowing when to sell is just as important as knowing when to buy, but it is a topic that gets far less attention in most investment writing, perhaps because selling feels like giving up and buying feels like opportunity, or perhaps because the right answer is more nuanced and situation dependent. But Charlie Tian addresses it directly and provides some clear principles. The first reason to sell is if the business fundamentals have deteriorated significantly. If the reason you bought the stock was the company's strong competitive moat, high returns on capital, and predictable earnings growth, and you now see signs that the moat is eroding, the returns are declining, or the growth is stalling, then the investment thesis has changed and you should reconsider your position, because the fact that you have a profit or a loss is largely irrelevant. What matters is whether the business still deserves to be in your portfolio based on its current and prospective merits. The second reason to sell is if the stock becomes significantly overvalued. When a great business becomes so popular and so widely recognized that its stock price gets pushed far above its intrinsic value, the margin of safety is gone, and in fact has become a margin of danger, meaning that even if the business continues to perform well, the stock may not go up much, or may actually fall as the valuation eventually normalizes. And Charlie Tian teaches that even if you love a business, there is a price at which you should be willing to part with it, because paying far too much for even the greatest business can lead to poor returns over the long run. The third reason to sell is if you find a significantly better opportunity. This is what Charlie Munger calls the opportunity cost framework. And the idea is that every investment you hold represents a choice to hold that instead of something else. And if you find a new opportunity that offers a significantly better combination of quality and price than something you currently own, it may make sense to sell the current holding and redeploy the capital into the better opportunity, because the goal is always to have your capital working in the most productive way possible and not to be attached to any particular holding for emotional reasons. The fourth reason to sell, which is actually a non-reason, is that the market has fallen and the stock price has gone down. Charlie Tian is emphatic that falling stock prices are not a reason to sell a great business as long as the fundamental business quality remains intact. And in fact, if anything, a falling price is often a reason to buy more of a business you already love and understand, because you are getting the same wonderful business at an even better price. And the investors who confuse a falling price with a declining business are the ones who sell at the bottom and miss the recovery, which is one of the most common and most costly mistakes in investing. Let us now talk about the role of patience in investing, because it deserves its own discussion. Patience is not just a virtue in investing, it is a competitive advantage. Most investors are impatient. They want results quickly. They get bored when nothing seems to be happening. They feel compelled to do something even when doing nothing is the right choice. And this impatience leads them to overtrade, to sell good investments before they have had time to mature, to buy into hot trends that have already peaked, and to make decisions based on short-term emotions rather than long-term analysis. The great investors, by contrast, are remarkably patient, and they understand that the best returns in investing come from letting compound growth work over long periods. And the power of compounding is one of the most profound concepts in all of finance, because even relatively modest annual returns, maintained consistently over many years, grow into enormous wealth over time. And the enemy of compounding is impatience, because every time you sell a compounding investment and pay taxes on the gains and have to find something new to buy, you interrupt the compounding process and reduce your ultimate wealth. Charlie Tian often references the holding periods of the greatest investors as evidence of how important patience is, and Warren Buffett has famously said that his favorite holding period is forever, meaning that when he finds a truly wonderful business at a reasonable price, he would like to hold it indefinitely and let the compounding work for decades. And while that is not always possible, because businesses change and circumstances change, the aspiration to be a very long-term holder rather than a short-term trader is central to the value investing philosophy. The interesting irony of patience in investing is that it requires you to be comfortable looking wrong or doing nothing for extended periods, because great value investments often take time to work out, and in the meantime, the market may continue to value them cheaply while other things are going up, and the psychological pressure to abandon a patient strategy and chase whatever is working right now is enormous and continuous, and resisting that pressure is one of the hardest things about being a long-term value investor. Charlie Tian addresses the psychological challenges of investing at some length, because he recognizes that investment success is not just an intellectual challenge, but also an emotional one, and many people who understand all the right principles still fail to implement them because their emotions get in the way. The single biggest emotional challenge in investing is managing fear and greed, and these two emotions operate in opposite directions, and both lead investors astray. Greed causes investors to buy when prices are high and excitement is building, to take risks they do not fully understand because they are afraid of missing out on gains that others seem to be making, and to hold on to investments that have become overvalued because they believe the price will keep going up. And greed is most dangerous near market tops, when everyone is making money, and it seems like the good times will never end. Fear causes investors to sell when prices are falling and panic is spreading, to avoid making investments that are actually attractively priced because the news is bad and the future seems uncertain, and to hold cash indefinitely even when excellent opportunities are available. And fear is most dangerous near market bottoms, when everyone is predicting disaster, and it seems like things will never get better. Charlie Tian teaches that the way to overcome these emotional biases is through discipline, process, and intellectual honesty, and specifically, the discipline of always going back to the fundamentals of the business rather than responding to price movements. The process of doing thorough analysis before making any investment decision rather than acting on impulse or hot tips, and the intellectual honesty of being willing to acknowledge when you are wrong and to update your thinking based on new information rather than clinging to positions out of pride. He also emphasizes the importance of knowing your own limitations and investing only in businesses you genuinely understand. And this is the concept of the circle of competence, which Warren Buffett has popularized. And the idea is that every investor has a circle of businesses they genuinely understand, industries they know deeply, business models that are transparent to them, and they should focus their investing within that circle and resist the temptation to venture outside it just because something outside looks exciting or cheap. Investing outside your circle of competence is dangerous because you cannot properly assess the risks or opportunities of businesses you do not truly understand, and you are competing against other investors who may know those businesses far better than you do. And in that situation, you are at a disadvantage and should not be surprised when things go wrong. The circle of competence also has the important property that it can be expanded over time through study and experience. And one of the great rewards of a lifetime of serious investing is that your circle of competence gradually grows, and you can recognize great businesses across more and more industries. And with each expansion, you also gain a deeper appreciation for the things you do not know and the appropriate humility about making claims beyond your genuine expertise. Now let us talk about the concept of what Charlie Tian calls the 20 punches approach. Warren Buffett has described the ideal investment approach using the metaphor of a punch card with 20 holes in it. And the idea is that you start with a card that has 20 punches, and every time you make an investment, you use one punch. And when the card is full, you cannot make any more investments for the rest of your life. And the question is, how differently would you invest if you could only make 20 investment decisions in your entire lifetime? The answer is obvious. You would be extraordinarily selective. You would only invest in businesses you understood deeply and had great conviction about. You would only invest when the price was clearly attractive relative to the value, and you would think very carefully about each decision rather than acting on impulse or following the crowd. And Charlie Tian suggests that investors should approach their real portfolios with a similar mentality, even if the actual mechanical constraint does not exist, because the discipline and selectivity that the punch card metaphor encourages is exactly the discipline and selectivity that separates great investors from average ones. Most people make too many investment decisions, too many of which are poorly researched and weakly grounded in genuine understanding, and the result is a portfolio that is mediocre because it is diluted with too many mediocre ideas. And if those same investors had applied the punch card discipline and made only their very best decisions with thorough research and genuine conviction, their results would almost certainly be much better. Let us now talk about something that Charlie Tian discusses in depth, which is the difference between a good business and a good investment. This distinction is crucial and often misunderstood, and the confusion between the two is responsible for many investment mistakes. A good business is one with strong competitive advantages, high returns on capital, predictable and growing earnings, excellent management, and all the other qualities we have discussed. And most investors recognize good businesses when they see them, because good businesses are generally well known, well admired, and widely covered in the financial press. But a good investment is something different, because a good investment is a business you can buy at a price that will generate attractive returns for you as an investor, and the price you pay is critical because it determines your future returns, regardless of how good the business is. And this means that a good business can be a bad investment if the price you pay for it is too high. And it also means that a mediocre business can occasionally be a good investment if the price is cheap enough relative to its assets and earnings. Charlie Tian's framework is most interested in the combination of a good business at a good price, and he argues convincingly that over the long term, this combination produces the best results, better than buying cheap businesses of mediocre quality and better than buying high-quality businesses at excessive prices. The reason the combination works so well over long periods is that when you buy a high-quality business at a good price, you benefit from two sources of returns. First, the growth in the intrinsic value of the business as it earns high returns on capital and reinvests those earnings to compound its value. And second, the potential for the market to recognize the full value of the business and close the gap between the price you paid and the intrinsic value. And these two forces, working together over years and decades, can create extraordinary wealth. Now let us discuss the concept of what happens during market downturns, because understanding how to behave during market crashes is one of the most valuable things any investor can learn. Market crashes are terrifying when you're in the middle of them, and history shows that they happen regularly, sometimes dramatically and suddenly, and every time they happen, the financial news is full of predictions that things will get worse and may never recover. And every time they happen, many investors panic and sell at the worst possible moment, locking in permanent losses on investments that would have recovered and gone on to significant new highs. Charlie Tian teaches that market downturns are not events to fear, but events to prepare for and ultimately to welcome, because they create the very conditions that allow great investors to buy wonderful businesses at truly attractive prices. And if you are a long-term investor with a sound understanding of business value, a market crash is not a catastrophe, but an opportunity, the financial equivalent of a sale at a store you love, where everything you wanted to buy is suddenly available at a significant discount. The key to taking advantage of market downturns is preparation, both financial and psychological. And on the financial side, Charlie Tian recommends always maintaining some level of cash or other liquid resources that you can deploy when opportunities arise. And he is not a fan of being fully invested at all times, regardless of market conditions, because being fully invested means you have no dry powder to take advantage of opportunities when markets fall. On the psychological side, the key is to have done your research in advance, so that when prices fall, you already know which businesses you want to own and what price would make them attractive, and you are not making decisions under the pressure of falling prices and frightening news, but rather executing a plan you developed in calmer times. And this kind of advanced preparation is what separates investors who profit from market downturns from those who simply suffer through them. Charlie Tian also discusses the concept of what he calls the false diversification that most individual investors rely on, which is the practice of owning many different stocks from many different industries as a way of reducing risk. And he acknowledges that diversification does reduce certain kinds of risk, specifically the risk that any one company will fail and take all your wealth with it. But he also points out that true diversification is better achieved through quality than through quantity. Owning 20 mediocre businesses is not as safe as it might seem, because in a broad market downturn, mediocre businesses typically fall more and recover more slowly than high-quality businesses, and what appears to be diversification is actually just a collection of correlated risks, while owning 10 truly high-quality businesses with strong competitive moats is in many ways a safer approach, because those businesses have the resilience and financial strength to weather downturns and come out the other side in good or even better competitive positions. Let us now talk about some of the specific metrics and screens that Charlie Tian uses to identify potential investment candidates. One of his preferred starting points is to look for businesses that have sustained high returns on equity, specifically averaging 15% or more over at least a decade, combined with reasonable debt levels. And this screen quickly filters out most businesses and leaves a smaller group of companies that have demonstrated genuine competitive strength over a long period. From that smaller group, He then looks at the predictability of earnings, using historical consistency as a guide, and businesses that have grown their earnings and revenues consistently year after year with minimal interruptions get a high rating for predictability, while businesses with choppy or unpredictable earnings histories get a lower rating, and businesses with very high predictability are ones where you can make confident estimates about the future, which is exactly what you need to do good valuation work. He then looks at growth rates, specifically how fast earnings have been growing over the past 5 and 10 years, and he tries to assess whether that historical growth rate is likely to be sustained going forward based on the strength of the business model, the size of the market, the competitive position, and other qualitative factors. He then does valuation work, looking at the current price relative to earnings, cash flows, and other measures, and trying to determine whether the stock offers a meaningful margin of safety at the current price, or whether it is fully or richly valued. And finally, he looks at management quality and capital allocation history, trying to assess whether the leadership team has a track record of making good decisions and creating value for shareholders over time. This process sounds simple when described in steps, but is actually quite demanding in practice, because doing it well requires both analytical rigor and business judgment, and the judgment part comes mainly from experience and from the habit of reading widely about businesses, industries, and economic history. Charlie Tian is a strong advocate for the habit of reading, and he points out that virtually all of the greatest investors are voracious readers who spend large portions of their working lives reading about businesses, industries, financial statements, economic conditions, and the thinking of other great investors. And this continuous intake of knowledge and perspective is what allows them to make better judgments about what businesses are worth and which ones deserve their investment capital. He recommends reading annual reports directly from the companies you are interested in, because annual reports contain more detail and nuance than any analyst summary, and they contain the words of management directly, which gives you an unfiltered window into how the people running the company think about the business and its future. And he recommends reading widely in business history because the patterns of competitive dynamics, industry evolution, and business success and failure repeat themselves in different forms across different eras and different industries. And knowing those patterns helps you recognize situations when they recur. He also recommends studying the letters and writings of great investors, and the single most recommended source in this regard is the annual letters that Warren Buffett writes to the shareholders of Berkshire Hathaway, which are widely considered to be masterclasses in business thinking, investment philosophy, and capital allocation, and they are available for free and cover more than 50 years of one of the greatest investment records in history. Let us now talk about the role of dividends in Charlie Tian's framework. Dividends are cash payments that companies make to their shareholders, typically from their profits, and they play an important role in the investment strategies of many long-term investors because they provide a tangible, ongoing return that does not depend on the stock price going up. And for investors who need income from their portfolios, dividends are particularly important. Charlie Tian places a lot of emphasis on dividend growth rather than just dividend yield, and the distinction matters enormously because a high dividend yield on a stock that is not growing may actually be a warning sign that the business is in decline or that the dividend is at risk of being cut, while a moderate dividend yield on a company that has been growing its dividend consistently for many years is actually a much more attractive situation because the combination of growth and compounding creates extraordinary returns over long periods. He points out that companies with decades-long track records of consistently growing their dividends are almost always the same companies with strong competitive moats, high returns on capital, and reliable earnings, because it takes genuine business strength to sustain and grow dividends through economic cycles, recessions, and all the other challenges that businesses face over the years. And a long track record of dividend growth is therefore one of the best signals of genuine business quality. The compounding power of reinvested dividends is also worth understanding deeply, because when you reinvest dividends over long periods, You are buying more shares of a compounding business with each payment, and those additional shares generate their own dividends, which buy even more shares. And the result, over decades, is that the dividend reinvesting investor ends up with a dramatically larger position than someone who started with the same initial investment but spent the dividends rather than reinvesting them. Charlie Tian illustrates this with historical examples showing that a very large portion of the total long-term returns from stock investing has come from dividends and their reinvestment rather than from price appreciation alone. And this is a counterintuitive finding for many investors who focus primarily on stock price movements and forget about the dividends, quietly doing their compounding work in the background. Now let us discuss the concept of what Charlie Tian calls avoiding value traps. A value trap is a stock that appears cheap by conventional measures, but is actually fairly priced or even expensive when you account for the underlying quality and growth prospects of the business. And value traps are a major hazard for investors who focus too narrowly on valuation metrics without paying enough attention to business quality. The most common form of value trap is a business that is in a declining industry or facing structural competitive threats, and that has seen its stock price fall so far that it looks cheap on the basis of current earnings or book value. But the problem is that those earnings are likely to continue declining. The book value may be overstated because the assets are less valuable than they appear on the balance sheet, and the cheap-looking valuation today may actually be generous relative to where earnings will be in 3 or 5 years. The coal industry, certain newspaper and publishing businesses, some traditional retail chains, and various other industries undergoing structural disruption have produced many value traps in recent decades, and investors who bought these stocks because they looked cheap on conventional metrics often suffered large losses as the underlying business fundamentals continued to deteriorate year after year. Charlie Tian's solution to the value trap problem is to insist on quality first and price second, and to avoid buying businesses that do not have genuine and durable competitive advantages, regardless of how cheap they look on the surface. Because a cheap price on a declining business is not a bargain, it is a warning. And the discipline to walk away from these apparent bargains is one of the most important skills a serious investor can develop. He also recommends being very honest with yourself about whether the cheapness you are seeing reflects a genuine misvaluation by the market, or whether the market is actually pricing in legitimate concerns about the business that you may be underestimating, and the market is not always wrong. In fact, for most businesses, most of the time, the market price is a fairly reasonable approximation of value, and when something looks dramatically cheap, there is usually a reason, and the first question to ask is whether that reason reflects a genuine opportunity or a genuine risk that you should be avoiding. Let us now talk about special situations and how Charlie Tian views them. Special situations are investments that are driven by specific corporate events rather than just by the ongoing business performance. Things like spin-offs, restructurings, bankruptcies, mergers, acquisitions, or other corporate actions that can create temporary mispricings that offer opportunities for patient and diligent investors. Charlie Tian acknowledges that special situations can offer attractive opportunities, but he approaches them with a framework rooted in business quality, meaning that even in special situations, he prefers to find those where the underlying business is genuinely good rather than simply betting on the mechanics of the corporate transaction, because if the underlying business is poor, the special situation may resolve itself in a way that still leaves you with a poor business at an average price, which is not particularly attractive. Spin-offs are one category of special situation that he finds particularly interesting because when a large company separates out a division into an independent public company, the newly independent business is often ignored or sold indiscriminately by institutional investors who received shares they did not want and did not ask for. And this selling pressure can temporarily depress the price of the spin-off below its intrinsic value, creating an opportunity for an investor who takes the time to understand the business and sees that it is being undervalued. Mergers and acquisitions create a different kind of opportunity because when one company announces it will acquire another at a premium to the current price, there is often still a gap between the current market price and the announced acquisition price, reflecting uncertainty about whether the deal will actually close. And investors who understand the specific situation well enough to make a confident assessment about the likelihood of deal completion can sometimes earn attractive returns by buying into that gap. But Charlie Tian is careful not to overemphasize special situations because his core framework is about finding wonderful businesses at fair prices and holding them for the long term. And special situations are more like opportunistic additions to that framework rather than a central pillar of it. Now let us talk about the global perspective that Charlie Tian brings to investing. While much of the greatest investment writing originates in the United States and focuses primarily on American markets, Charlie Tian himself brings a global perspective that is increasingly valuable as investment opportunities become more diverse across different geographies. He recognizes that great businesses exist in every corner of the world, and that investors who limit themselves to their home markets are artificially constraining their opportunity set, and in some cases, are missing out on businesses with exceptional quality and attractive valuations that are available in other markets. At the same time, he is honest about the additional complexities and risks of international investing, including currency risk, political and regulatory risk, accounting differences that can make financial statements harder to compare, and the practical challenges of researching businesses in industries and geographies where you have less familiarity and fewer informational resources. His guidance is that international investing can be worthwhile, but requires the same quality-first discipline as domestic investing, and in fact, probably requires even more attention to quality and competitive moat, because the additional risks of international investing mean you need a higher degree of confidence in the fundamental business quality to justify taking on those additional risks. He also notes that the great investors who have succeeded in international investing have generally done so by sticking to businesses they genuinely understand, often businesses that are similar in nature to businesses they already know well in their home markets, or businesses in industries with universal economics that transcend geographic boundaries, and they have applied exactly the same analytical framework of moat, predictability, valuation, and management quality that they use in their home markets. Let us now turn to a discussion of what Charlie Tian has to say about the role of financial statements in investment analysis. Understanding financial statements is a foundational skill for serious investors, and Charlie Tian devotes significant attention to helping investors understand how to read and interpret the three main financial statements: the income statement, the balance sheet, and the cash flow statement, and how to use the information in those statements to assess business quality and valuation. The income statement shows the revenues and expenses of the business over a period of time and calculates the profit, and the key things to look for in the income statement are the trend of revenues over time, the trend of gross profit margins and operating profit margins over time, the quality of earnings, meaning whether the profits reflect genuine economic activity or are being inflated by accounting choices, and the relationship between revenue growth and profit growth, which tells you whether the company is scaling efficiently or whether its costs are growing as fast as or faster than its revenues. The balance sheet shows the assets and liabilities of the business at a point in time and the difference between them, which is the shareholders' equity. And the key things to look for in the balance sheet are the level and trend of debt, the quality of the assets, meaning whether they are genuinely productive and worth their stated values, the presence of intangible assets and goodwill, which can sometimes be significantly overstated, and the overall financial strength and flexibility of the company. The cash flow statement shows the actual cash coming into and going out of the business over a period of time, broken into operating activities, investing activities, and financing activities, and the cash flow from operations is particularly important because it shows how much real cash the core business is generating. And comparing this to the reported net income can reveal a lot about the quality of earnings, because genuine, high-quality earnings are generally accompanied by strong cash flow generation, while earnings that are inflated by accounting choices often show a gap between reported profits and actual cash generation. Charlie Tian teaches investors to look at all three statements together rather than focusing on any one in isolation, because the full picture of business health requires understanding revenues and profits from the income statement, balance sheet strength, and the quality of assets from the balance sheet, and actual cash generation from the cash flow statement. And any business that looks good on all three is genuinely sound, while discrepancies between the statements can often reveal hidden problems. He is also a strong advocate for reading the footnotes to financial statements, which is where management is required to disclose information that does not fit neatly into the main statements, and the footnotes often contain important information about accounting choices, contingent liabilities, related party transactions, and other matters that can significantly affect the true economic picture of the business. And while reading footnotes is tedious, it is often where the most important investment-relevant information is hidden. Let us now discuss what Charlie Tian says about the relationship between quality and price over different investment time horizons. Over short periods, price is everything. If you buy a wonderful business at a terrible price, you can still lose money in the short term as the valuation normalizes from overpriced back to fairly priced. And conversely, even a poor business can generate good short-term returns if you buy it cheap enough and hold it until the market recognizes the cheapness and the price recovers. But over long periods, quality becomes everything. Over 10 or 20 or 30 years, the compounding power of a high-quality business with durable competitive advantages and high returns on capital dominates the initial valuation, and the investor who bought a wonderful business at a somewhat high price ends up far ahead of the investor who bought a mediocre business at a very cheap price, because the wonderful business has been compounding value at a high rate for all those years, while the mediocre business has been struggling to maintain its earnings and reinvesting capital at low rates of return. This is one of the most important and most counterintuitive insights in all of investing, and it is the reason that the greatest long-term investors have evolved from being pure bargain hunters, focused exclusively on cheapness, to being quality hunters, focused primarily on business excellence, and treating price as an important but secondary consideration. Charlie Tian reinforces this point repeatedly because he believes it is so fundamental and so frequently misunderstood, and he argues that the investor who spends most of their time trying to find cheap stocks in mediocre businesses is working much harder than the investor who spends most of their time finding excellent businesses and then waits patiently for those businesses to become available at reasonable prices. Because the second approach, while it requires patience and occasional periods of holding cash, almost always produces better results over the long run. He also addresses the practical question of how to define a reasonable price for a high-quality business, and his answer is that a reasonable price is one where you are paying a moderate multiple of current earnings, something in the range of 15 to 25 times earnings for a business growing at a healthy rate, provided you have high confidence in the durability of the competitive moat and the predictability of future earnings growth. And he is willing to pay somewhat more than the traditional value investor would for businesses that have exceptional quality and predictability, because the compounding over time justifies the premium. Now, let us discuss the importance of knowing the history of the businesses and industries you invest in. One of the most consistent characteristics of great investors is that they are students of business history, and they study not just current businesses, but also how industries have evolved over decades, how competitive dynamics have played out over time, and what has made certain businesses durable and others fragile. And this historical knowledge provides a context that pure financial analysis cannot, because it helps you understand the patterns and forces that are likely to shape the future. For example, an investor who knows the history of the newspaper industry understands how newspapers once seemed to be unassailable local monopolies with wide competitive moats, and how the advent of the internet completely destroyed that moat by providing free access to information and taking away the classified advertising revenues that were the financial backbone of the newspaper business. And knowing this history helps you think more clearly about other businesses that might appear to have strong moats today, but could be vulnerable to similar disruption. Similarly, an investor who knows the history of the automobile industry understands how it went from being an exciting growth industry with dozens of competitors in the early 20th century to being a brutally competitive, capital-intensive, cyclical industry dominated by a small number of players, none of whom has been able to consistently earn high returns on capital. And this knowledge helps you think clearly about other industries that might seem attractive today, but have structural characteristics that will prevent them from being wonderful long-term investments. Charlie Tian encourages investors to read business history broadly, including not just the histories of individual companies, but also the histories of industries, economic cycles, and the broader evolution of capitalism over the past century and more, because this breadth of historical knowledge is what allows the great investors to see patterns and make connections that others miss. Let us now talk about the concept of what Charlie Tian calls the durability test. Beyond asking whether a business has a competitive moat today, the durability test asks how likely that moat is to persist over a long investment horizon. And this is a different question from just asking whether the moat exists, because some moats are structurally durable, while others are inherently fragile, even if they look strong at any given moment. A brand moat, for example, can be extraordinarily durable when it is backed by a product that genuinely creates real value for customers and has deep emotional resonance, as with the great consumer brands that have lasted for generations. But it can be fragile when the brand is fashionable rather than genuinely valued, because fashion changes and what is cool today can be embarrassing tomorrow, and investors need to think carefully about which kind of brand they are dealing with. A network effect moat can be among the most durable in existence once it reaches a certain scale, but it is also the case that new technologies sometimes create new networks that can displace old ones faster than people expect, and the investor needs to think carefully about whether the network's value proposition is genuinely essential, or whether it is one good product innovation away from being challenged. A switching cost moat can be very durable in certain kinds of enterprise software and infrastructure, but it can be eroded by technological change that makes switching easier than it used to be, or by regulatory change that forces companies to be more interoperable. And again, the investor needs to think about whether the switching costs are likely to remain high or whether they might erode over time. Charlie Tian teaches that the most durable moats tend to be those that are rooted in multiple sources of competitive advantage simultaneously. For example, a company that has both a powerful brand and high switching costs and a cost advantage. And when several sources of competitive strength reinforce each other, the overall moat is much harder to attack than when a company relies on just one source of advantage. Now let us address the question of when to start investing and how to build a portfolio from scratch. Charlie Tian's answer to when to start is simple. The best time to start investing with the right approach and the right companies is as soon as possible, because time is the most valuable resource in compounding wealth, and every year you delay is a year of potential compound growth that you will never get back. And the investor who starts 10 years earlier with the same amount of money and the same annual returns will end up with enormously more wealth simply because of those extra 10 years of compounding. For someone starting to build a portfolio, he recommends beginning with a thorough study of the principles of quality investing, specifically understanding what makes a great business, how to identify competitive moats, how to assess management quality, and how to evaluate whether a stock is fairly priced. Because without this foundation, you are simply guessing, and investing without a sound framework is indistinguishable from gambling. He then recommends starting with businesses in industries you know well or that you can understand relatively easily, because the circle of competence principle means your best investments will be in areas where you have genuine insight and can make more confident judgments than the average investor. He also recommends starting conservatively In terms of position sizes, not putting too much of your portfolio in any single investment until you have developed the confidence and experience to judge quality accurately, and gradually building up positions as your conviction and understanding increase. And he strongly recommends treating your early investment decisions as learning experiences as much as financial ones, because the mistakes you make early, when stakes are lower, are the most valuable education you will ever get. And the investor who learns from early mistakes and uses them to refine their process will almost always become much better over time. Let us now talk about the relationship between macroeconomic conditions and individual stock selection. Charlie Tian's view, consistent with the great value investors he admires, is that macroeconomic forecasting is largely futile, and that investors who spend most of their time trying to predict where the economy is going, where interest rates are headed, what inflation will do, or who will win the next election, are wasting time and attention that would be much better spent understanding individual businesses. The reason macroeconomic forecasting is so difficult is that economies are enormously complex systems with billions of interacting variables, and even the most sophisticated economists with the most advanced models regularly make large errors in their predictions. And the financial markets, which are driven by the collective expectations of millions of participants, are very efficient at rapidly incorporating new information. So even when you get a macro forecast right, the market may have already priced it in. Charlie Tian's preferred approach is to focus primarily on business quality and valuation, and to treat macroeconomic conditions as a background context rather than a primary driver of investment decisions. And the practical implication is that he looks for businesses that are resilient across a range of economic conditions, businesses with pricing power and low capital intensity, and strong competitive positions that allow them to perform well, whether the economy is growing quickly or slowly, or even contracting temporarily. This does not mean macroeconomic conditions are irrelevant, because they can certainly affect the valuations at which stocks are available and the rate at which great investment opportunities present themselves. And during periods of significant economic stress, when asset prices fall broadly, quality investors with cash available can find exceptional opportunities that are not available in calmer times. And this is one of the reasons Charlie Tian advocates always maintaining some cash or liquidity rather than being fully invested at all times. But the key is not to let macroeconomic concerns paralyze you or lead you to make poor investment decisions based on predictions that are inherently unreliable. And many investors have sat on the sidelines for years, waiting for the perfect moment when the economy looked safe to invest, missing years of compound growth in wonderful businesses, and they would have been much better served by focusing on individual business quality and buying the best available opportunities regardless of the current economic environment. Let us now discuss what Charlie Tian says about the power of simplicity in investing. One of the most striking insights that comes from studying the great investors is how simple their approach actually is at its core. And Charlie Tian emphasizes this because he believes that many investors make things much more complicated than they need to be, and that the added complexity does not produce better results, but actually often makes things worse by obscuring what is really important. The core of Charlie Tian's framework can be summarized simply. Find businesses with durable competitive advantages. Ensure those businesses have long track records of high returns on capital and predictable earnings growth. Make sure management has demonstrated excellent capital allocation over time. Buy those businesses when they are available, at prices that offer a reasonable margin of safety relative to intrinsic value. Hold them for as long as the business fundamentals remain intact and the valuation remains reasonable. That is essentially it. Everything else in his framework, all the specific metrics, all the screening tools, all the various valuation methods, are in service of these 5 simple principles. And while the execution requires skill and judgment that takes time to develop, the underlying framework is not complicated. And the investor who masters these 5 principles and applies them consistently with patience and discipline will achieve excellent results over the long run. Charlie Tian also points out that simplicity has an important psychological advantage, because when your investment process is clear and simple, you can communicate it clearly to yourself and to others. You can check whether your investment decisions are consistent with your stated approach, and you can maintain conviction in your portfolio during difficult periods because you understand exactly why you own what you own and what would cause you to change your mind. The investor whose process is complicated and multifaceted tends to lose clarity when markets are volatile, tends to find themselves able to justify almost any decision post hoc, and tends to drift from one approach to another in response to recent results. And this lack of clarity and consistency is corrosive to long-term performance. Let us now discuss what Charlie Tian has to say about the role of the investor community and the wisdom of crowds. The efficient market hypothesis, which is the academic theory that stock prices always fully reflect all available information, and therefore no investor can consistently outperform the market, has been debated for decades, and Charlie Tian takes a nuanced position on it, acknowledging that markets are generally quite efficient, but arguing that they are not perfectly efficient, and that the inefficiencies that exist are large enough and systematic enough to be exploited by investors who are sufficiently disciplined, patient, and thoughtful. The main sources of market inefficiency that Charlie Tian identifies are behavioral, meaning they arise from the consistent psychological biases of investors rather than from any lack of information. And these behavioral biases include excessive short-termism, meaning investors' tendency to overweight near-term news and underweight long-term fundamentals; excessive extrapolation, meaning investors' tendency to assume that recent trends will continue indefinitely; overreaction to bad news, meaning investors' tendency to sell heavily in response to disappointing results, even when the long-term business fundamentals remain intact; and herding behavior, meaning investors' tendency to buy what others are buying and sell what others are selling, regardless of whether the prices make sense. These behavioral biases create systematic patterns of mispricing that patient, disciplined, long-term investors can exploit, and the basic approach is to take the other side of these behavioral excesses, to be a buyer when the crowd is irrationally fearful, and a seller or abstainer when the crowd is irrationally greedy. And while this sounds simple in principle, executing it in practice requires enormous psychological strength because it means consistently acting against the grain and being willing to look wrong in the short term. Charlie Tian also discusses the role of the investment community in generating the information and research that investors use to make decisions, and he notes that while there is an enormous amount of investment research published every day, much of it is not particularly useful for the long-term fundamental investor because it is focused on short-term catalysts, quarterly earnings surprises, near-term price targets, and other things that do not affect the long-term business value in meaningful ways. He encourages investors to be selective about the information they consume and to focus primarily on primary sources, particularly company annual reports, investor presentations, and the writings of great investors, rather than spending too much time on analyst reports, financial television, or online investment forums, because the signal-to-noise ratio in most financial media is very low, and the constant flow of information can actually be harmful to investment discipline by creating a sense of urgency to act that is rarely justified. Now let us talk about the concepts of moat widening and moat narrowing in more detail. Charlie Tian teaches that one of the most valuable things an investor can do is to try to assess not just the current width of a competitive moat, but the direction in which the moat is heading. And a moat that is widening is far more valuable than a moat that is narrowing, even if they look equally wide today, because the widening moat will protect an ever larger economic franchise, while the narrowing moat is slowly being eaten away. Signs that a moat is widening include growing market share, rising profit margins, increasing customer loyalty, growing brand strength, network effects that are accumulating as the user base grows, and management investments in innovation and customer value that are paying off in superior competitive positioning. And when you see these signs, you are looking at a business that is becoming more valuable over time in ways that compound the returns to shareholders. Signs that a moat is narrowing include declining market share, falling or compressing margins, increasing customer churn, brand equity that is eroding as younger consumers develop different preferences, technological disruption that is making the company's products less distinctive, and management that is cutting costs rather than investing in the future. And when you see these signs, you need to think carefully about whether the investment thesis is still intact or whether the business is slowly losing its competitive edge in ways that will ultimately affect the economics. Charlie Tian is particularly interested in identifying businesses where the moat is widening but is not yet fully recognized by the market, because these are situations where you can buy into a compounding machine at a still reasonable price, and as the market over time comes to recognize the strengthening competitive position, you benefit from both the compounding of business value and the re-rating of the market's valuation of that value. Let us now discuss the concept of total shareholder return and how it relates to business quality. Total shareholder return is the combination of stock price appreciation and dividends that an investor receives over a holding period, and it is the ultimate measure of investment performance. And Charlie Tian analyzes the long-term total shareholder returns of different categories of businesses to demonstrate empirically that the principles he advocates actually work in practice. The data consistently show that businesses with high and stable returns on equity, businesses with strong competitive moats, and businesses with consistent earnings growth substantially outperform the average over long periods. And while there are always short-term periods where the relationship breaks down and low quality, cheap stocks outperform, over periods of 5, 10, and 20 years, the quality premium is very consistent and very large. He also shows that the businesses tracked by Guru Focus that are most heavily owned by the great investors, the ones whose portfolios show consistent buying in a particular stock across multiple Guru investors, tend to outperform as a group over the following years, which is another form of evidence that the quality-focused, value-oriented approach that the great investors embody actually produces superior returns. This evidence is important, not just academically, but psychologically, because investing by quality principles often requires you to hold businesses that are not generating excitement in the market, to avoid the hottest trends, and to look conservative and boring compared to investors chasing the latest hot thing. And knowing that the historical data supports your approach gives you the conviction to maintain it through difficult periods when other strategies seem to be working better. Let us now come to a discussion of what Charlie Tian considers to be the most important qualities that a great investor needs to develop. The first quality is intellectual curiosity. Great investors are genuinely curious about how businesses work, about the economics of different industries, about what makes some companies able to sustain high profits while others cannot. And this curiosity drives them to study and learn continuously, to read widely, to ask questions, and to seek understanding that goes beyond what is on the surface. And investors who are not genuinely curious tend to stop learning after they achieve a basic level of competence and miss the insights that come from deeper and broader study. The second quality is independent thinking. Great investors are willing to form their own views based on their own analysis, and they are not afraid to disagree with the market consensus or with conventional wisdom when their analysis leads them to a different conclusion. And this independence is not contrarianism for its own sake, but rather the natural result of thinking carefully and honestly about what you see. And the great investors are sometimes right when everyone else is wrong, because they have done better analysis and are not subject to the crowd psychology that drives consensus. The third quality is emotional control. As discussed at length earlier, the ability to manage fear and greed, to make decisions based on analysis rather than emotion, and to maintain discipline during periods when it is psychologically difficult is one of the defining characteristics of the great investors and one of the hardest qualities to develop. And it requires self-awareness, intellectual honesty, and the kind of patience that can only come from deep conviction in your investment approach. The fourth quality is intellectual honesty. Great investors are honest with themselves about what they know and what they do not know, about when they are right and when they are wrong, and about the limitations of their analysis, and they update their views when the evidence changes rather than defending their original positions out of pride. And this intellectual honesty is what allows them to learn from mistakes rather than repeating them, and it is what keeps them from falling into the trap of confirmation bias, where you only notice and remember the information that supports your existing view. The fifth quality is patience. We have discussed patience several times already because it is truly foundational to great investing, and it takes time for quality businesses to compound their value. It takes time for the market to recognize mispricings and correct them. It takes time for investment theses to play out, and the investor who does not have genuine patience will inevitably disrupt this process by acting on short-term impulses rather than waiting for the long-term reality to assert itself. The sixth quality is the ability to do nothing. This sounds like a trivial or even humorous quality, but it is genuinely one of the hardest things for most investors to develop, because the financial industry and financial media are constantly suggesting actions and creating a sense of urgency that does not actually exist. And the great investors understand that doing nothing is often the right response to most market conditions, and that excessive action is one of the main drivers of poor investment performance, because it generates costs, disrupts compounding, and often results in selling good investments too early and buying mediocre ones. Charlie Tian closes his teaching with a message about the long-term nature of investment success, and it is worth understanding deeply. Investing is not a sprint, it is a marathon, and the qualities that make for great short-term performance, being quick to react, willing to take concentrated positions in hot trends, comfortable with high risk for short-term gain, are often the opposite of the qualities that make for great long-term performance, which are patience, discipline, focus on quality, willingness to look boring in the short term, and the ability to let compounding work over decades. The great investors that Charlie Tian has studied and whose portfolios he has tracked are not people who got rich quickly by making bold bets. They are people who got very rich slowly by being consistently right about business quality and patient enough to let time work for them. And the compounding of even moderate annual returns over decades creates extraordinary wealth in a way that quick wins and losses never can. He encourages investors at every stage of their journey to embrace the long-term perspective, to measure their success not by what happened in the last quarter or even the last year, but by whether their portfolio of high-quality businesses is compounding value at an attractive rate over rolling 5- and 10-year periods, and to use any periods of underperformance as opportunities to check whether their process is still sound rather than as reasons to abandon it. The final message of Charlie Tian's work is one of optimism grounded in reality, because the great businesses of the world are genuinely wonderful things that provide enormous value to their customers, create well-paying jobs for their employees, generate returns for their investors, and contribute to human progress and prosperity. And investing in these businesses at reasonable prices and holding them for the long term is not just a path to financial wealth, but also a way of participating in and supporting the best of what capitalism can produce. And that, at its core, is what investing like a guru really means. It means thinking clearly and honestly about which businesses are truly excellent, having the discipline to pay a fair but not excessive price for them, having the patience to hold them while they compound their value over years and decades, and having the wisdom to know when the thesis has changed and it is time to move on. And the investors who master these principles, not perfectly, but consistently, and with genuine commitment, will build real and lasting wealth over the course of their investing lives. And they will do it in a way they can be proud of, by understanding deeply what they own, by thinking independently and honestly, and by letting the power of compounding and quality work its magic over time. That is the essence of investing like the world's greatest investors. And now you have the principles, the framework, and the mindset to begin applying them, and the journey from here belongs entirely to you.